Welcome to ICAN Success Academy, the academy that shows students 100% success in the examination and in just a city. Today, we're going to look at financial accounting for the beginners. That is, we're going to start from the scratch to tell students what is accounting, how to record financial transaction, and how to confirm our accounting equation, the assets equals to equity plus liability. As you can see on the board, the financial accounting FA for beginners. So let's start with the definition of accounting briefly. Accounting is a recording of financial transaction. After you have recorded this financial transaction, then you prepare a financial report, and this report is used for decision making. So what we're saying about the definition of accounting is 1. Recording of financial transactions. 2, you prepare financial statement or record and report. 3, the prepared financial statement or reports are used for decision making. That is simple as that. That is financial accounting. So if you look at the number 1 key phrase, recording of financial transaction. What is financial transaction? Financial transaction is any activities, business activities that involve cash or credit. As you can see, this is an example of financial transaction. The owner deposited $50,000 cash to the business, or bought stocks on credit $5,000, paid telephone account by check $1,000 to the 7th transaction. So that is financial transaction. You're going to record it systematically, and after recording it, you prepare a financial statement and financial report. Then this report is used for decision making. That is all about financial statement. So let's look at So after knowing the meaning of financial accounting, let's look at the levels or steps that you need to start when starting with the financial accounting, when starting your financial accounting preparation for the beginners. Now, we're going to look at the accounting equation. Accounting equation. And this is the first topic on the board. We're going to look at the journal entries. We're going to look at the ledgers. We're also going to look at the trial balance, and the rest. So, as you can see, we're starting with the accounting equation. Please listen attentively. Accounting equation, as you can see on the board, it says that our assets equals equity plus liability. The addition of liabilities and equity gives you assets. What is asset? Assets is what you own, what you have in the business or in the company. They are your assets. Then equity are your claims. That is your investment. Your investment in the business, they are your equity. Equity is in two forms. Those that reduce the equity and those that increases your equity. Like the capital, which is an investment, any investment to a business is called capital. Your capital increases your equity. Your income, the income is also part of the equity. It increases the equity. But drawing from the business, what is drawing? You, the owner of the business, you take some cash for your personal use. That cash that you take from the business is called drawing. That cash that you drew from the business is called drawing. Then expenses, whatever you spend in the course of the business, you spend for charging your handset recharge card, you pay for stationaries, you pay for rent, you pay for electricity. They are your expenses, and expenses is under the equity. Now the liability part of it is your obligations. You're always what you ought to pay. If you take loan, you will pay back that loan. Bank overdraft, you will pay back the overdraft. So today, as you can see, we have our assets, the column of assets, equity, and liability. So our assets, let's know our assets. For this level, we have land and building as an asset. We have machineries. We have equipment, other equipment. We have cash or bank. For this level, we have our debtors, or you call it trade receivable, receivables. We have debtor, trade receivable. We have our inventory, or you call it stocks or goods, stocks. So for this level, these are our assets: the land and building, machineries, equipment, cash, bank, debtors or trade receivable, inventory. So if you look at this, they are what the company have or what the business have as their own properties, that is assets. So if you come to the equity part, the equity, I've told you that any investment, money or anything for investment is called capital. And here they are your claims. We say capital is your equity. Then this capital, it increases your equity. It carries positive. Then we have income, and the equity part, income. This income also increases your equity. We have expenses or expense. This expense reduces your equity. And drawings reduces your equity. For this level, this is what we have under equity. And for liabilities, we have your creditors, or we call it trade payables. The opposite of debtors or trade receivable. Then we have loans, loans, we have bank overdrafts. Bank overdraft. Bank overdraft. Drafts. So this, for this level, these are your liabilities. And so, please take note of this, put it down, because they are very important and necessary in accounting. You must know your assets, you must know your equity, you must know your liability. And you must take note of those items that increase your equity and decreases your equity. Like the expense you spend, it will decrease your claim. Your drawings, if you drew from the business account for your personal use, it will decrease your claims. This is capital. It increases your equity, your claim, that is the investment. Whatever you bring into the business, it will increase your claim. And income, anything that comes in as a result of income, payment for the rent that you give out, the house that you give out in form of rent, they pay you rent, is an income. So these are items under equity. And here, land and building, machinery, equipment, cash or bank, debtors, trade receivable, inventory or stocks. So in this cash or bank, modern accounting, whenever a transaction is made by cash, when we are recording, we use bank. Everything cash, check, we use bank. If the bank is stated, we use bank. If it is cash, we use bank. I hope that is clear. Yeah, it is clear. So let's proceed. After knowing the items under the elements, that is the assets, the equity and liabilities, let's go straight to confirming our equation that assets equals to equity plus liability. That is, the addition of equity and liability will give you your assets. Let's confirm it. But before we confirm that, there is a principle that will guide us to confirming if our assets is equal to equity plus liability. And that principle is called the double entry principle. This principle says that for a particular transaction, this is a transaction. For this transaction one, there must be two accounts for one transaction. One for debit and the other one for credit. Simple as that. That is the meaning of this double entry accounting principle. Whenever you have a transaction, you're going to have two accounts, one for debit and one for credit. That is simple as that. Okay, since it's said like that, let's see the equation. This principle is going to guide us to confirming this our equation that says assets equal equity plus liability. Now, let's look at our first transaction. Our first transaction says the owner deposited $50,000 cash to the business. Now, let us identify the two accounts in this transaction. As we said earlier, that we're going to identify two accounts here, and by identifying two accounts, let's identify the first account. The owner deposited. So this is an investment. He's investing to the business. And we say any investment to the business is called the capital. And from the list of items that I just, you understand, we just locate where capital was. It was at the equity column. Capital was at the equity column. column because the owner depositing is an investment. He's investing to the business. And we say if it is cash or bank, we use bank. If it is cash, we use bank. So now we have identified the first transaction, the first account to be the capital account. Capital. I hope you're following. Yes, you're getting it. Now, the second account is the cash, which I say we're going to use bank. That is bank account. Very simple. Capital account and bank account. Simple as that. So let's see. The owner deposited $50,000 cash. So we come to the equity side where we have our capital. We say our capital is what? Let's put the currency sign here. Let's put the currency sign. Let's put the currency sign. It's very important in accounting. Let's put the currency sign. So depositing, investing is capital. We have identified our capital account. So you come to the equity side. Since capital falls under equity, you say your transaction is 50,000. Is 50,000. And it is what? Capital. Let's abbreviate. Capital. It is capital. So the second account is bank. And on the list of items under assets, bank falls under assets. So you come here and say that same 50,000 naira, that same $50,000, sorry, not naira, dollars, and it is your bank account. So now, do we have any accounts here apart from assets that will fall under assets, equity, and liabilities? No, these are the two accounts identified. So now our liability now plus liability, which is 0. And don't forget, your bank balance is being deposited. So your bank balance is a positive balance. And your capital now is positive. So now let's confirm the equation. $50,000 plus 0 liability, it will give you your positive $50,000. Simple. So from this transaction, the equation is being confirmed. Let's go to the second transaction. The second transaction says, let's identify the accounts. Bought stocks on credit, $5,000. Now, you're paying to acquire, to get your stock, but this is on credit. There is no any payment. So the stock here, this is our stock account, inventory or stock, which was under assets, and your creditors or trade payables, which was under the liability columns. So now let's treat it and see. You come here, stock, you say is $5,000. $5,000, and the stock is coming in, that is, it is increasing, is a positive value or stocks. Now, trade payables or creditors is under liabilities, and it's worth $5,000, and it is increasing your obligation. You have not settled it, so it is a positive. It increases the obligation. Now, The equity, there is nothing like equity here. If you look at the transaction, there is no capital, there is no income, there is no expense. You didn't pay for it. You are yet to pay for it. So our equity is zero, nothing. So let's confirm the equation. Our liability plus zero equity, $5,000 positive plus zero liability equity equals 5,000 positive assets. You see, the equation is balanced. That says our asset equals to our equity plus liabilities. So let's continue. Paid telephone account by check, $1,000. Paid telephone. You see, whenever you pay, it's an expense. You are spending, it's an expenses. So, and the expense is on telephone. This is an expense account, expense account under telephone. And the expense was by check. Check is bank account. Very simple as that. So you come here, our expense is under equity. If you look at the items under equity, then it reduces the value or equity. Now, our expense, you say, is $1,000. You say $1,000. Then the next account is bank. Our bank is assets. And it reduces your equity. Though it's negative. And for the bank, you paid using check. Though it will reduce the balance of your bank account. So this $1,000 will be negative. It will be negative 1,000. Plus, do we have anything like liabilities here? We don't have liability, we have paid for it. So our liability is zero. Now, let's confirm the equation to see if it is balanced. Our 1,000 or 0 plus 1,000, negative 1,000, it will give you negative 1,000. So it is confirmed that our assets equals to our equity plus liability. Let's go to the fourth question that says bought stock by check, 2,000. Now let me pause a minute and see if do this for us and see if you will get it before we do it. Just try to work it yourself and see if you can get it. Okay, I'm waiting. Okay, let's continue. Now check your answer, check what you did now and see if it is the same with what you're going to do now. Okay, bought stocks by check, $2,000. Now you bought stocks. Let's identify the accounts. Here is stock, inventory, the stock account, inventory or stocks account, and here is bank account. Simple as that. So let's confirm the transaction to see if our equation will balance. Now, you see, this is your stock account, and the stock falls under assets column. Now, your stock, and it is $2,000. You say $2,000. What is the implication? The implication is stocks. I could not put the narrations here. This question, transaction 2, it is stocks. The narration is stock. You put the stock. You can put it stocks. And here is payables. What you will pay. And for this, the third transaction, Here is the third transaction. Here is bank. You put your bank, and for the equity is expense account. You put your expense account. For the fourth transaction, transaction 4, we say it is stock account, and our stock is assets. So we buy it. Since we bought it. Now our stock is increasing, so it will increase. A positive stock or value. Our positive should be there. Now by check, which is bank account. Don't forget, bank is also under the assets column. This under assets. Bank is our asset too. But now here you are paying using bank account. So it will reduce the balance of your bank account. So this your 2000 will be negative 2000 of bank. I hope you're following. Yeah, you're getting it. So it will be negative. So your positive 2000 minus negative minus 2000, it will give you 0. I hope you're following, you're getting it. So there is nothing like equity here, no expenses. There is nothing like equity, and there is nothing like liability. So you come to your equity, you say 0 equals to 0 plus your liability which is 0. So the liability is 0 plus equity 0. It will give you your 0 assets. So this equation is balanced. Let's go to the fifth transaction. The fifth transaction says paid suppliers $4,000 cash. Paid suppliers $4,000 cash. Now, this is, if you look at this, you're paying is an expense account. Expense account, and it is affecting the suppliers. And here is our cash, which is our bank account. So we have identified the account. Let's just put it. Now I know you can do it by now. So our expense is under equity of $4,000. So you say equity $4,000, and expense reduces the equity. Is expense plus, you have liability in the equation, in the transaction. There's no liability, it is cash, and cash or bank is under the asset. Here is 0. Then our bank $4,000 bank equals to, and this $4,000 we pay. So it is reducing the balance of our bank account. So 0 liabilities plus minus, that is negative 4,000 expenses, equals to that same negative amount. So this transaction also balanced. That is how you'll be doing it. Let's proceed. For the purpose of you, the beginners, the owner drew 3,000 for personal use. Please just do this transaction for us, just a minute. Pause the video, just do it for a minute and see where it will be the same with your working. Okay, let's continue. Now let's identify the accounts in the transaction 6. The owner drew, here is drawing account. $3,000 for personal use. Here, there is not cash or bank. So whenever you see a question like this, it is either cash or bank or check. So is our bank account. This is our bank account. So we have identified the transaction. Let's put it and see. Drew, that is drawing account, and our drawings is under equity. So our drawing reduces the amount of equity. So let's see, minus $3,000. $3,000 as drawing. Then the next account is bank, which is $3,000. $3,000 bank equals is bank. Now, since he's taking the $3,000, he's reducing the balance, the bank balance, the balance of the bank account. So is negative. So, and your liability now is zero. There's no liability in the transaction. So your zero liability plus 3,000 negative as drawing, it will give you 3,000 negative bank account. So the question is balance. Let's look at the last transaction, which says paid monthly rental of $3,000 to the company. He's paying to the company. It's not that the company is paying. So this is a rental income. It is an income. This your rental is not an expense, it's an income account, since he's paying to the company. Not that the company is paying rent, but it is the rental is the rental, the amount paid for the rent is going to the company. Now is income account. And this income, just as we did here, there is no specification of bank or cash. It is either bank or cash, or bank or cash or check. So we say we consider it as bank account. Simple as that. Now let's see, let's put it as C, rental income account, and we say our income, the item fall under the equity column, which is $3,500. $3,500 as our income, rental income. And don't forget, income increases the equity. So your equal signs. Now, the bank now is under assets. We say $3,500, and it is coming in, so it is a positive. It increases the bank account. Here is the narration is bank. So if you look at it, all the transaction is balanced and confirming the assets equals to equity plus liabilities. This is what we did, and I hope you get it very well. So please, if there is any question, don't forget to drop it at our comment section, and also don't forget to subscribe to our YouTube channel, the ICAN Success Academy, and click on the notification bell icon that will pop on, and also click on all, so that whenever we release our videos, it will come to you immediately. Do us a favor again and share our videos so that our videos will move viral. Thank you.